Hoping to save some last minute tax? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And at the time we're recording this video, right near the end of the UK tax year that ends on the 5th of April every year, it is of course a fun time. And we're interested in helping people make sure that they've kind of covered all their bases. Is there some allowance they didn't know about and things like this? And I thought actually it's a great time to come on and just do a little bit of a checklist for you of things to consider. And as always with these videos, these things are going to be based on UK small business owners. So, you know, your tax resident here in the UK, you've got a small business, be it a limited company or a sole trade or a partnership. And there are some things in there for non-business clients as well, but generally it's going to be in this kind of area. And if there's anything specific that only applies to limited companies or something like that, then I will do my best to remind myself to tell you that as we talk through this video. Now, before we get into the bulk of this video, if you do like these type of things, make sure to click the subscribe and the bell so you get notified whenever we release more videos just like this one. So then the first thing to do, and it's the most obvious, is to make sure that you're using your UK personal allowance. Now, most UK tax residents are going to get a tax allowance. It's about 12.5 grand a year is the easiest way to think about it, where you can earn money tax-free from various sources. And for most people, that's going to be covered by either full-time employment and things like that. For business owners, quite often it's going to be covered because you're going to have maybe a salary if you're a limited company, or if you're a sole trade, your profits are going to hopefully be more than 12k a year, but not for everybody. There are circumstances where you might have, for example, come out of a job, maybe you got made redundant and had this big wad of cash in the previous tax year, and then you've started a limited company, for example, and you haven't had any salary, and maybe you're not using all of your allowances. You've not got enough income on paper, and it is a use it or lose it allowance. So make sure you're just thinking about, have I got enough taxable income on paper? Particularly if you're thinking of getting a mortgage or lending or anything, you need to be able to prove your earnings, and a tax return is often the way to do that. So making sure you've got taxable income is important, and I think you don't want to lose out. So I could go on a big old list of all the different reasons why this might be the case, but I think you would know. You'd think like, yeah, okay, have I earned any money on paper this year? That's really what you're thinking about. And if you haven't, speak to somebody, just think about what your options are, but just consider, have you used your personal allowances? There are other allowances that I'm not going to mention. We've done other videos about them, but there are things like property allowances and trading allowances and all these things that allow you to reduce your profits. They're more of a tax saving tool necessarily, but they're kind of use it or lose it allowances. So if you have got these other sources of income, it might be worth checking those videos out as well. Now, whether you're a business owner or not, if you do like to give money to charity, you might have heard the term gift aid, and it's a mechanism for basically giving money to charities. And if you are going to make any charitable donations to these like bigger charities with gift aid, it's a good time to do it. It only really impacts you if you're in the higher rate of tax, you're earning more than about 50k a year. That's the only time you'd start to really feel it in your tax return. That and above, but it is a good time to do it. So you can do that, you can log it on your tax return. So if you are thinking of doing those things, they can be quite useful tools. So have a look about those if you are thinking about charitable giving. And again, along the lines of could be for everybody, if you are married, the UK tax system is a bit of an oddity in that marriage is still quite a key concept in a lot of areas of tax. And there is this thing called the marriage allowance that allows you to transfer some unused allowances to somebody else, to your spouse. Now, it's quite restrictive, and we don't often see it in the small business world, particularly limited companies, because there's ways and means of splitting income and doing things efficiently already. But in some circumstances, that marriage allowance transfer can be really, really good. There are some pitfalls to it, so it's not for everybody, and it doesn't work where one of you, say, a higher rate taxpayer, so you're earning over, say, 50 odd K, one of you, and the other one's got like minimal income for various different reasons. That's stopped because I think a lot of people would use it in that area. But just know that that is potentially available. So if you're married and you're in a situation where neither of you's earning more than 50 odd grand, might be worth looking at that one. And again, that one actually you can backdate on occasion as well. So that's there. Investigate whether that's for you. Now, if you're selling big stuff, again, this isn't specific to businesses, but if you're selling what I call big stuff, so you're selling shares, property, crypto, like all these things that could end up having capital gains attached to them. And that's another type of income that gets taxed. There's a separate allowance for that. So like there's this annual exempt amount that you get. It's only a mere £3,000 in the tax year we're talking about now, but it's still worth considering because it is kind of use it or lose it. So if you are thinking, actually, I'm going to sell a load soon, you might choose to say sell some now, this side of the 5th of April, use your £3,000 allowance. So the first 3,000 worth of profits tax tax-free effectively. And then in the next tax year, then sell on the other side of the 5th of April. So it could be quite a good way to do it if you're thinking about it. I know right now, as I'm recording this video, there's all sorts of people scrambling around to sell businesses and do all these things to utilize various allowances. So that's worth thinking about. And I think it's particularly at the time we're recording this video in March 25, ready for the 5th of April 25. There's quite an important thing around what used to be known as entrepreneurs relief. So if you're selling a business right now, you definitely want to be talking to your advisors about is that important? Is the 5th of April important for you? And that's all to do with capital gains. But do think about these capital gains allowances. While we're on the subject of big stuff, let's talk about for your business. So if you're in business, whether you're a limited company or a sole trader, particularly this tip, really this main checkpoint for this is thinking about if your limited company ends, your limited company year end finishes on 31st of March, say, so it runs in line with the tax year, or if you're a sole trader where your year will be the tax year, now's a good time to think about bringing forward any expenditure on the bigger stuff. So if you can if you're going to go buy a laptop, go pick it up and start using it in your business before the 5th of April, before the 31st of March, if you're a limited company and that's your year end, what will actually happen is you could accelerate the tax relief. Many of these items have different allowances on them, things called annual investment allowance, or sometimes just the way the tax return works for your sole trade might mean you get a full allowance for buying this entire laptop. Although the laptop's going to last you many years, actually the relief available means you're going to get it all knocked off your profit now. So if you're thinking it's almost the worst time to buy it in those scenarios is kind of like the 7th of April, because if you bought it a few days earlier for your sole trade business, you could have impacted the next tax bill. So just think about bringing those things forward. Now, I'd never say to go and spend money just to save tax. We've done loads of videos on that. And I think there's I personally think it's a great video talking about what tax deductible actually means. But every time you're spending money, you're only saving a percentage of that money in tax. So you've got to know that it's money you were going to spend anyway. But if you were going to spend it, think about just bringing it forward. And this tip's particularly relevant without going too much into detail on it if you're a sole trader using the cash basis. So what that means is that you prepare your tax return and fill in your tax return based on the money you spent and the money that came in during the days. So of course, as you imagine, if you're going to go and buy a load of stuff and spend money before, you're going to have more expenses. That's going to reduce your profits, reduce your tax bill. But it's also relevant where you don't if you're thinking of using big equipment. So things like, I call them big equipment, but things like laptops, computers, they're the most obvious things we see. So do consider those and maybe bringing those forward a little bit. Now let's talk pensions. Please don't switch off, but because I know there can be a bit of a sort of a boring subject. But if you are looking to invest in your pension, there are annual allowances every year that mean you're capped on the amount you can contribute. Now they're pretty substantial for your average person, so it's not often that you would hit the caps. But if you've got a chunk of money in the business or a chunk of money sitting around that you're thinking of doing, consider the fact that these caps do exist and it's worth using them. You have got a bit of flexibility where pensions are concerned, because quite often if the circumstances sort of work and the criteria is met, you can bring forward some unused allowances from previous years. So they're not entirely use it or lose it, but there's only a certain time frame that you can do this in. So if you're considering putting into a pension, do that. If you're a limited company and you're thinking about putting into a pension, think about how you would do that. I don't want to go too much detail in here, but there is a thing known as employers' contributions that is probably the way you would want to look at doing it in many circumstances, rather than doing it personally. But personal contributions also potentially have a really good effect on your tax bill depending on where you are. So it depends if you're sole trade, depends if you're limited. But if you are thinking about pension, do some research, get some help. And now is always a good time to be thinking about that and arranging for these payments to be made. Now, while we're on the subject of limited companies, you might have heard of something called trivial benefits. It's a really weird tax relief that's designed so that you can give any member of your team a small present, I guess, like on their birthday or a bottle of wine at Christmas or whatever the case may be. We've done other videos, blogs, podcasts on this. Just type in trivial benefits on any of our sort of content areas and you'll find a video on that. If I can remember, I'll even try and link it here. But there's an annual cap on that runs with the tax year for directors of limited companies. And for some people who like to kind of min-max that type of thing, it's a good idea to have a look and just see, like, is there a couple of, is there still a £50 gift in me to for something that I need that might fit that criteria? But it's very specific criteria, so check out those individual videos, but just know that the cap resets. And while we're talking about cap, I didn't actually think about it until I've been talking about it on this video, but there's also, if you've got mileage, business mileage that you're doing for a personal car, that also runs with the tax year, and that those reliefs are reset. So again, just think about your mileage claims while you're there thinking about these other sort of small caps. Now, still on the subject of limited companies, we did mention at the beginning making the most of your personal allowance. So to me, it's almost criminal. It's not actually criminal, but it feels criminal when I see a client has formed a limited company, they have got no other incomes, they're not using their personal allowances, and they've not declared them any technical payroll. And again, there's videos that we've done on this, but there is a real reason why you would want to. One, if you don't get the right value on that payroll, you're potentially losing out a state pension qualifying year. It's a mouthful, but it's the thing that makes your pension what you get at the end of when you come to retire, and they say this is your pension, is based on the amount of these qualifying years, is an absolute key factor in that. And you will lose out if you don't have enough income on paper for this year. And that's very easily achievable for most people with some payroll through their company. And that also gets a tax deduction in the limited company. So in the right circumstances, it's really important. And it will also, on top of that, make use potentially of that personal allowance you've got. So if you've got no other income and you've got a limited company and it's your main deal, I seriously recommend that you investigate looking at salary very soon before the year end is out to make sure that you've got everything in order, everything's submitted if salary is a good idea for you. But don't waste it, because I mean, for your average person, it's worth at least 1,800 quid's worth of corporation tax deduction. So it's something you do not want to miss out on. So definitely go and have a look if that's right for you. And not only is it right, but is it the right level for the reasons we just said? Is it at least the amount you need to get a state pension qualifying year? Is it, have you got enough? Just have a look at those levels, and again, seek help if you need it. Now, one final one on limited companies. We couldn't talk about limited companies without talking about dividends, of course. Now, for many people, dividends is the profit. If you don't know, we've done an absolute ton of videos on this. You can go and watch hours of me talking about dividends. They're there, but just know that if you want to take some money out of the company and you haven't, let's say you're a really small startup and actually you haven't really made much money, but there's a bit of money on paper for you to take, and that's important, and those videos will explain that to you, then you might want to think, well, I have got a £500 a year dividend allowance where I can have £500 of dividends without paying any personal tax on it. So you've made profits in the company, you got some money there, it's there on paper, and you want to maximize this allowance, you've got no other dividends, you've got £500 there to play with. It used to be a lot more exciting. It was a couple of grand a few years ago, but they've absolutely hammered that into the floor over the last few years. But hey, every little helps, they say. So have a look at that £500 worth. Now, talking of boring stuff, ISAs. So they're, these savings accounts are out there that are tax-free. They sound really cool because they say tax-free. But what we will say to people is a reminder that, because you'll hear and you'll see lots of financial stuff where they're talking about, use your ISA allowance. There's only so much you can pay into an ISA every year, but for the average person, that's quite a lot of money anyway. But also you've got the fact that you have separate saving income allowances. So for most people, you're not going to pay tax on the first £500 to £1,000 worth of, depending where your income is, worth of interest anyway. So you've got to kind of weigh up, well, if that's not an ISA, technically it's taxable, but I'm going to get it tax-free anyway. Is it better to be in that account versus the ISA, which might be less interest but tax-free? I can't tell you. It's regulated financial advice, but you can go and have a look for yourself. I'm sure you can figure that one out, and just have a look and see what's best for you. But if you did need to utilize those ISAs, those allowances are only there and they reset as well. So have a look at that. And there's tons of information. Everybody does videos on that. So go and have a look, and I'm sure you can come to the decision of whether that's right for you. On top of that, you've also got, and this one definitely wants advice, is there are very tax efficient investments you can make in certain types of, say, stocks or shares, and they give you tax relief. And that can actually generate quite a lot of a tax refund on your tax return. They're generally considered higher risk. So that's definitely worth getting some help with if you're thinking of doing that. But again, it would be remiss of me not to mention there are these tax reliefs for investing in those types of investments. So check those ones out if that's in your area and something you want to get involved with. Now, when we talk about risk, giving money to people, you could always say that's a risk. We've all, lent family money, I'm sure, and then think, am I ever going to get this back? But there is actually, if, you have got a bit of excess cash and you're thinking of gifting some money, there is an allowance every year where you can gift something out of your estate. So it's an inheritance tax thing, but you can give some money away and it comes out of your estate and ends up in the hands of somebody else. It's quite a useful thing to think about every year. And again, I'm not going to go too much in detail. You can Google that one about the limits and what happens. But there is something you can do if you did want to give some money to somebody. Now, if you've got kids, I want to talk about this one because there has been some changes to child benefit, and I might do another video purely talking about the tax consequences of this. But at the back end of the budget, they talked about the fact that they were raising the limit. So at the minute, anybody receiving child benefit that earns up to 60 grand is no problem at all. But if one of you in that household earns more than 60k, that person has to pay a percentage of the child benefit back each year in what's known as the high income benefit charge. Now, that goes all the way to about 80,000 before you lose all of the child benefit. You have to pay it all back. Now, you should think about that through the year. And the reason I'm talking about that now is because you might think, well, I'm just not going to claim. But there are pitfalls to not claiming, and that's what I want to highlight. And again, you can Google this, but there are consequences to not registering and not getting it. And there is a way to basically register for child benefit, not physically get paid the money. And you might think, well, that's a bit pointless, but there are benefits. Things like your state pension record, we just mentioned, state pension credits that it's known as. And also, your children might not get their national insurance number automatically issued at the time of recording this video if you don't do these type of things. So do check that out, because obviously we're coming towards the end of the tax year and it's kind of tax year based. So child benefit, put that on your list, regardless of where you are. If you've got kids, I think that's worth looking into. You don't actually have to take the money, but have a look, see if that's for you. And then finally, we couldn't leave you without talking about the most ultimate tax saving tip of all time. If somebody says to me, and it happens frequently in comments, what's the best way to save tax? Absolutely. The number one thing, you ready? Keep good records. That's it. Keep good records. Try and do it as much digital as you can. Try and make it easy. So try and use capture technology. So if you're a small business, you'll want to use things like Dext or, all these tools that are out there, or HubDoc or whatever, or QuickBooks Native Snap app, or whatever the case may be. There's lots of ways of having receipt capture apps, because there's nothing worse than you're out and about. I was talking to a client about this literally on the morning of recording this video, and they've been out and they've been on travel for work, and they bought themselves a coffee and a cake, right, for their subsistence. They're out work, didn't have breakfast, had to be on a train early, whatever else, going to a temporary workplace. It was all going to be fine from a tax perspective. And they paid cash and they lost the receipt. They forgot about it. That's a tax deduction gone. And if you think about it, if you paid it from your pocket, you'd have paid, if for a small business, you would have paid income tax or national insurance, or if you're a limited company, you would have paid corporation tax, and then potentially paid like what's known as dividend tax, but income tax on it again, to get that money in your pocket to then pay it. Whereas if your business pays for it, you're paying it before tax. So it really does make a difference. And if you do that over the course of a year, i.e. you forget and you don't record all these things, it can be really bad for you. I've seen clients. I saw a client who's an adult entertainer who got investigated by the revenue, and they didn't have any of the receipts. So the revenue just went, okay, well, there's your tax bill. Now, I'm sure with a bit of thought and a bit of record keeping, the tax bill would have been vastly less than it should have been. And if we'd been acting for them at that time, we absolutely would have argued some of these things. But it's really important to know that records are so important to everything you do. So boring as it may sound, that is absolutely it. So get everything in order. If you do your own tax return, make sure you start to gather your forms. So you'll start to get your P60 for the end of year if you're employed, something known as a P11D, which is a taxable benefit form. There's all these things. Anything to do that looks like it's tax, start to hoard and keep it ready for your tax return, because the revenue do have certain data about you, but I'll say half the time, that's probably an exaggeration. But more often than you would think, the data they hold can be wrong, and those documents are going to be really, really important for making sure that that's the right figure to go on any tax returns or give to your accountant if they're helping you. So there we are. There's some last minute tax saving ideas for you. If you did enjoy this video, please do share it with people that you think also need to know this. Subscribe and all the rest of it, and I'll see you in the next one.